Today I thought we've got earnings dropping all around the places we have for the last week or so. Today I thought we'd focus as our stock of the day on not one but two in the same sector. Two of the buy now, pay later names have dropped their results today. Afterpay and Zip, the two biggies. Afterpay's full year loss has blown out to almost eightfold as it doubles marketing spend to tap new markets, despite revenue climbing almost 80% on its way to $1 billion. $160 million loss is almost double what analysts have been forecasting after larger than expected share-based payment costs and financial liabilities push the bottom line way out. I'll be getting all the very latest details from Chief Executive and Founder Anthony Eisen right after the call here at 1 p.m. Eastern. And of course, Zipco's losses have also widened to more than $650 million. Company upping its true cost of its QuadPay acquisition in the United States, as well as more than $150 million in new expenses. Total transaction volumes, however, climbing 180%. For the year, bad and doubtful debts also lower on a year earlier. And Peter Gray, founder of Zip, joins us here on ausbiz a bit later in the afternoon at 3:15. So I've got two of the founders on this afternoon as we get all the movers and shakers. Henry, first to you. What do you think of Afterpay and Zip's results, and how do you see them at this stage on the market?
Hi, David. It's a bit of a tricky one, isn't it? Because both these results were pretty much telegraphed in advance to some extent. And it's really now a question of selling the sizzle with these guys, the founders, the CEOs, etc., hitting the airways. I've just seen them plastered all over CNBC, and you guys have got them on as well. For Afterpay, though, it's a whole different ballgame, because it's all about really the Square share price these days, because it is under takeover. They have this scheme of arrangement. So it is a factor of the Square share price. So where the Square price goes, the Afterpay price will go. And it's about selling that deal, about selling the synergies and the strategy going forward for the company rather than the raw numbers. Undoubtedly, the numbers are big. They've always been big. Active customers, 16.2 million. Active merchants, 98.2 thousand. These are both big, massive percentage increases from last year, 63 and 77% respectively. So the numbers are big. What is, I guess, worrying is that it costs a lot of money in marketing to get Afterpay up and going in a territory. And we can see that with the net margin now is falling slightly now, 2.1% from 2.3% for Afterpay. So some of those marketing costs, no doubt, going into getting new merchants on board and cutting those costs for merchants. And there is a bit of a war going on in pricing with Apple coming along and PayPal, etc. So Afterpay, very much a function of the Square price. If you work it all out, it gives you a valuation for Afterpay around this morning of around $140.42 going on that Square share price of $270 with a 0.375 conversion ratio and doing the currency switch. As far as Zip goes, I guess the jury is far more out with this one. Initially, the market didn't really like it, and I've got to say that right down on QuadPay was a bit, that wasn't so good. But you know, there are brokers that have got very low valuations on Zip, and they have brokers like Shaw and Partners who have got a $16.25 valuation on this stock. So there's clearly, the Shaw guys think there's some upside there. Jonathan Higgins, who's the analyst around there, is pretty good on this buy now, pay later stuff. But I have to say, I was a bit ho-hum on the results from Zip. I wasn't completely convinced, and I think they're going to have to do a lot more sizzle selling, if that's the right word, to get some interest. Interestingly as well, they've got a massive short position in the stock. I think around 9.8% of the stock is shorted. Yeah. So just adds to the complications. But at the moment, I think, you know, I'd like to see how the chips fall in the next few days. But there was nothing very fantastic about the result, but equally there was nothing nasty apart from that QuadPay write-down. So for me, I guess they're both a hold, and the market's saying that with the reactions to the results today.
Yeah, they are lightning rod stocks, aren't they? I
Yeah, they
noticed
are. They are.
they have the lovers and the haters. I saw a UBS report out today on Afterpay. They've got a price target of $45. And if you look at UBS has been, ever since it floated, has been a sell, no matter what it got to. And then there are other brokers who just have fallen in love with them and say it's all about building market share and customer base and da-da-da-da. So they really split opinions quite markedly to two extremes. Andrew, what did you think of them?
Yeah, look, the Afterpay result, my learned friend is bang on. It's sure the market's looking at what the result is, but normally when it's profit reporting season, it's 20% what you've done, 80% what are you going to do in the future. And we know in the future that the Afterpay wagon is hitched to Square. There's people stuck with them Square. Square's really got some exciting things going on with Jack Dorsey. So certainly if I was a Afterpay shareholder, I would remain there. Of course, being the ETF guy, I'd say stick with ATEC, ATEC. And that's how you're going to get your Square exposure, because of course they'll be tradable on the ASX as a CDI. Probably the big takeaway from the Afterpay result, as Henry said, is just that significant marketing spend that's going on at the moment. And we'll talk about Zip in a moment. They've equally got that going on as well. There was also significant investment in staff costs as well, which is arguably viewed as an investment. But really, what it comes down to is that they've got around 30% of their customers are coming to them directly from using the app. So if you compare and contrast that to old school finance, you'd go into a bank branch and you'd get signed up by a manager or a teller or whoever it may be, whereas Afterpay has completely bypassed that model. As long as you've got a mobile phone and you've got access to the App Store or the Play Store, 30% of their customers are coming directly from that. So you can see why there's that big marketing spend. So overall, Afterpay result was good, but we're really now looking at the Square result. In the context of Zip, I think I've seen some commentary that describes it as messy and lots of costs in there. There was also an increase in provision for bad and doubtful debts, which is a little concerning, not market, but it's a bit concerning. And certainly, as I just mentioned before, that marketing spend. So I note consensus on Zip is around $8.62 prior to this result. That will change post the result, but if I had to choose one of the two, I'd be choosing Afterpay, because having Square in my corner, I could certainly think of worse things to be happening to me.
Yeah. So do you stick with Afterpay and go the Square conversion, Henry, or see, ever since the Lowies sold out of Westfield, I always think when the founders sell, it's time to get out, no matter who you are, because they've seen the top of the market, they're going, although these guys are staying with Afterpay, and that would be part of the takeover that Square would have stitched them up to keep running it. But is it the top of the market? Sort of margins were being squeezed.
It's a great exit strategy for Afterpay, I guess, in some respects, and it shows that you do need to spend money to get that market share, and maybe it is hip to be Square. I am, looking at the UBS valuation of Afterpay at $45, that would imply that their Square valuation would be whatever, like $90, I guess, a third or a quarter of where they are now. So that's a bit strange for me. I guess if you're going to buy into the Square thing, you're going to have to buy into it lock, stock, and two smoking barrels. I would prefer, I must admit, to be maybe cashing up in Afterpay, taking the money and running. I'm always a little concerned when you get these big Goliaths of companies, Square and Afterpay. They are Goliaths, behemoths, if you like. There is sometimes a clash of culture. Now, I know it's all very well for the founders to say, no, we like Jack Dorsey. We've been there, we've shaken hands, we've broken bread with him, and everything's cool and cushy. But there's still a whole big company behind these Afterpay people that founded it that have got to integrate to some extent with Square. And there's a lot of jostling for position. It's not always easy, these cultural fits. And I think, I don't know whether ATEC, as Andrew says, the ATF, whether I don't know how they're going to treat Square in the ATEC thing, because Afterpay is such a massive part of the tech index here on the ETF. It's going to be interesting to see how local investors treat Square when it's listed here. And we've certainly seen in the past that there is a tendency for local guys to exit. They don't want the hassle. They don't want to know what's, that something happening on the other side of the world is going to have such a massive effect on their shares here. So I think if I was an Afterpay shareholder, which unfortunately I'm not, I think I'd be lightening the load into the market and just sitting back and waiting how things settle.
Yeah.
Maybe even switching into Zip as the sort of the next cab off the rank with that leverage to the space. And there's always potential for, someone to come along with Zip and do a share swap there. But I just think these takeovers are troubled sometimes.
Yeah. Andrew, you're always very big on what founders and directors and chief executives skin in the game. How do you view founders cashing in?
Oh, look, I think, again, I'm agreeing with Henry very early in the show. I'm setting the wrong tenor here, but he's absolutely...
Plenty of show to come, Andrew.
There's certainly plenty to be mindful of relating to that whole culture clash. I think I've recounted previously when I worked for Macquarie, we were actually acquired by Macquarie, and about a third of the staff of the old firm left in the first 18 months, not because Macquarie was terrible to work for, far from it, but it's just a different culture, different systems, different processes, different mindset, and people don't cope with that. So are there going to be sort of agreements to be keeping key staff, not just the founders? I think that's a really important one. Koshy, you mentioned Westfield just before, and obviously Frank Lowy and co absolutely timed that to a T. But with due respect to Frank, he was probably closer to retirement than not. And
the boys were running it.
Yes, but ultimately these founders love control, and if they can't have control, then it's take it or leave it, basically. Yeah. So from my point of view, Henry's bang on as a risk management strategy. Me personally, as long as the growth thematic stays in track for growth companies and tech companies, I want exposure to Square, and the proxy to do it. Just checking the weighting in ATEC, Afterpay is currently 22% of ATEC, so it'll be interesting to see if that ratio holds. I think it's March next year is when the transaction's concluded.
Right, okay. And I'll put the question to Anthony Eisen as well. When he comes on a bit later, if you're selling out, why? But and see how long he's locked into Square for.